Danny, the Nasdaq been pulling away, especially from the small caps, the Russell 2000, just a slow bleed. Tell me if you look at this as a sign that the U.S. economy is truly in trouble and we should be looking at the stock market's bounce as an aberration, or if this is a good opportunity. Walk me through it.
Hey, Oliver, thanks for having me. So what we're seeing is that the stocks that you would think would suffer, retail, small cap, highly levered companies, haven't really taken part in this rally to any extent like the Qs. And there's been, I wouldn't say crowding, but there's definitely been a flight to safety, and that safety has been in growthier, large cap tech names. So, year to date, it looks like the Qs are up 1.5%, whereas Russell's down roughly, I think it's 36%. So you're seeing that everyone is kind of piling into the same stocks, which, for good reason, it's been working. And even like the week over week change, you can see last week, IWM was down roughly 1.5%, whereas Qs were up 6%. So you're seeing even on a weekly basis, on the rallies, on the sell-offs, Qs keep outperforming. And, as a firm, we think for the near term, that probably continues. The risk right now that we're seeing is that earnings are about to start. This week and next week is like the heavy earnings season for Qs, heavy earnings seasons for small cap. And our concern is that as the data comes in, there might be some profit taking as earnings are reported, sort of a buy the rumor, sell the news. And what we've been sort of focused on, especially into earnings, is maybe hedging some of these better performing sectors, in particular Nasdaq.
If the small caps are, in such bad shape, and I think your point here is a good one, which is that it kind of makes sense that these are the companies that are lagging the most. How far can you get that gap between two different parts of the stock market while they may be indeed very different? Is that something that is bound to come back in, that either as you look at it through relative strength, if you look at it just through a normalized chart where you can see the percent changes? I mean, no matter how you slice it, the way the Nasdaq is pulled apart from the Russell 2000 is fairly unprecedented. I mean, it really only goes back to .com type of situation. So there's almost like this kind of bubbly action forming in the Qs, where I imagine after a certain point you have to hope that the rest of the market catches up, or else it makes the Nasdaq look a little bit out of place.
Right, and I think the more likely scenario now is that maybe Nasdaq comes a little bit back down to earth as opposed to a huge small cap rally. What we saw 2 weeks ago was that small cap, junky, high short interest names pop. So you can have these short squeezes here and there. So it's like, that's why, shorter dated maybe occasionally look for IWM calls as a trade. The longer term, we think this chart that you posted here continues, where Nasdaq outperforms Russell. The thing is right now we have all of the earnings starting. We know correlations are also super high within the S&P, within Russell, within Qs. So it's like, if you're long Amazon, I think it's easy to make a bullish argument for Amazon considering what's going on. Everything that has happened should benefit Amazon long term. But the stock, maybe some of that's already priced in and everyone's already there, and you get the data coming out and it somewhat disappoints, or maybe expectations were a little bit too high. So from our view is like, well, maybe you get a small cap rally, maybe you don't, but there's a chance that over the next 2 weeks, Qs back up a little bit here. And with this huge rally, we say use that to your advantage. Look for short dated hedges. And if these stocks sell off, we know they're all been very correlated. That's how you get a chart like this. Use the profit you make from your hedges to potentially buy more after the news at a cheaper level.
Now, Danny, this is pretty interesting. I know that with this spread blowing out between the two indexes, you've also got a chart here I'm looking at, just looking at volatility of that spread, and it looks pretty similar, right? Very, very high. In fact, as high as we can see over the past decade. I know this is kind of a macro question still, but you can take it from the options standpoint, whichever way you want. Is it possible that because we're kind of seeing the future pushed forward here, that maybe the historical range at which this relationship trades in might gravitate upwards as well? And not to say this is like the new normal where the spread and the vol is going to be as high as it is right now, but is there a possibility that it mean reverts down to something that is at a higher mean if what we're seeing is, well, hey, this is just the world we live in now, man, and Amazon runs the world?
Right. I think that's right. I think like clearly this is extreme, but in a 20 to 30 point range. And what this chart is showing is just the 10-day realized volatility of the spread of IWM to Qs. So it's just kind of showing that how fast money is moving from small cap to Qs and to back to small cap, and just shows you like the velocity of money. And yeah, I would expect this to stay elevated. And I think what we're waiting for and what we're going to see is you kind of need some bankruptcies to start appearing. And that's when perhaps the bottoming process in small cap starts happening. Whereas right now, we don't think that the small caps have hit a bottom. There might be some weeks of outperformance where small caps get that short-term rally when Qs maybe underperform, and we think that could happen the next 2 weeks. But yes, I agree with you. Longer term, you'd expect this volatility between small cap and Qs to kind of stay elevated, and that's presents trading opportunities almost on a weekly basis. And you see how fast everything is moving now.
Do you think right now the opportunity is through, let's say you want to do a trade like this where you basically fade the Nasdaq and kind of fade that spread? Do you do it through selling calls because volume for calls are in such demand right now after the move? Can you actually buy? Do you want to own options and volatility right now, or is volatility too high and paying up too much for premium? What does the kind of structure of the option market look like in your mind, and how to actually put this type of trade in action?
So the way we've been setting up pairs trades, and one pairs trade we had on was being long Qs versus short IWM trade that's worked fairly well, is the funding vehicle. You want to sell a call spread as opposed to an outright call, because you don't want to basically blow yourself off. If you're short a call, the potential losses are infinite. So if you wanted to get long Russell because you actually think it rallies relative to Qs, we'd say sell a Qs call spread to buy a Russell call. As for now, we would say don't be long IWM, but it seems like the downside risk for the next 2 weeks is a little bit higher in Qs, considering the outperformance, considering the crowding into those sectors. So we'll look more so and maybe put spreads in Qs versus potentially selling put spreads in something like an IWM, especially this morning as Russell's down over 2% and Qs look like they're down about 90 bips.
Got it. Yep. Right now, that spread's still showing up. Okay. So before we let you go, Danny, I like this point. I want to shift gears a little bit, because also in your notes, you're looking at some of the precious metals. Gold last week, as mentioned at the top of the show, made a high, then kind of faded as the market picked up some steam. What do you see right now in terms of gold, silver? It looks to me like from your notes, you're more interested in silver.
Yes. Silver's been such an underperformer that it's almost like a catch-up trade. The options market is super liquid. On a relative basis, it's cheap versus historical. It's not as cheap as it was a few weeks ago, but still, it's been such a massive underperformer. Now, you need the economy to pick up. There's more industrial uses for silver. But the one thing we've been seeing is there's been a ton of call buying in the SLV ETF. And what can potentially happen is that as a stock rallies, the person on the other side of a call, if I sold you a call, my hedge is to go and buy stock. So if everyone is buying calls, the more that stock rallies, the more the hedger of the short call has to go and buy stock. So you could see sort of a short squeeze on the call side on silver. And that's one thing we've been focused on. All this call volume has created a potential demand for more SLV ETF as it rallies. So what we've been looking at is 3-4 month calls and call spreads in silver to give you some time for this to work, play some catch up. And we still think it should work in a risk-off environment, especially as a catch-up trade relative to gold. And then the ideal scenario is you get a rally, and then that rally is exacerbated by dealers who are short calls forced to hedge. And the way, again, they hedge those short calls is buying stock. So you could see like maybe a blow-off move to the top as like almost it'll feel like a short squeeze.
This is the like gamma squeeze that people talk about that we've seen in other instruments and volatility before. Are there particular parts of the option chain that look like this is concentrated in, where it could potentially happen?
Sure. So SLV right now is, I think, 14 and change. This would be above 16 and 17. That's where we're seeing a lot of the call interest. There's been a ton of Jan 21 strike calls being bought. So again, you have to kind of move out of this range, this 12 to 15 range. But as we go up, again, you're going to see the person who is short all these calls, the dealers who are short all these calls, their hedge is to go and buy stock, and it kind of creates a sort of self-perpetuating action. We see this occasionally in the S&P, we see this in Qs, we see this in single stocks. We think there's a chance it happens in silver.